What is the bond yield curve? Have you ever wondered how investors decide which bonds to buy and why some bonds seem to offer better returns than others? The bond yield curve is a key tool in understanding this. So, what exactly is the bond yield curve? It is a graphical representation that shows the interest rates or yields of bonds that have the same credit quality but different maturity dates. On this graph, the horizontal axis represents the time until the bond matures, ranging from short-term to long-term. The vertical axis shows the yield or interest rate that investors earn from the bond. This curve helps illustrate how the market values bonds over various time frames. Typically, bonds with longer maturities offer higher yields. This is because investors want to be compensated for the increased risk of holding a bond for a longer period. As a result, you usually see a yield curve that slopes upward, which is known as a normal yield curve. There are three common shapes of the yield curve. The first is the normal upward sloping curve. This indicates that longer-term bonds have higher yields than short-term bonds. This shape reflects expectations of economic growth and inflation over time. Next, we have the inverted downward sloping curve. This occurs when short-term yields are higher than long-term yields. An inverted curve often signals expectations of an economic slowdown or recession. Lastly, there is the flat curve. This happens when short-term and long-term yields are very close to each other. A flat curve suggests uncertainty or transition in economic conditions. For banks and credit unions, the bond yield curve is an important tool for several reasons. First, it serves as a benchmark for setting interest rates on loans, mortgages, and deposits. For example, banks often price loans based on yields of government bonds with similar maturities. Second, the shape of the yield curve provides insights into market expectations about future interest rates and economic activity. This helps financial institutions manage interest rate risk effectively. Third, banks and credit unions invest in bonds themselves. Understanding the yield curve helps them decide which maturities offer the best risk-return balance. Finally, the yield curve influences how banks manage their funding and liquidity. It affects the cost of borrowing and lending over different time frames. In essence, the bond yield curve is a foundational concept in fixed income investing and financial management. It reflects how investors are compensated for lending money over different periods and serves as a key indicator of economic trends. Understanding the bond yield curve can help you make informed investment decisions and navigate the world of personal finance more effectively.